March 10, 2000. The NASDAQ closes at 5,048. Everyone is a genius. The internet has changed everything. Then nothing. For 15 years. If you put $100,000 into the NASDAQ on that day by October 2002, you had $22,000. And you didn't get your money back until April 2015. I want you to actually sit with that. If you were 50 years old in 2000, your money was underwater until you were 65. Everyone talks about the crash. Nobody talks about the recovery. Because the recovery was the hard part. And here's what's genuinely unsettling. We are currently living through a cycle that rhymes almost perfectly with what came before. Not necessarily a prediction, but a pattern worth understanding before it's too late. By the end of this video, you will understand 6 lessons from the dot-com crash that almost nobody has internalized, including the one about crashes inside crashes, which is the thing that actually destroys people. Stick with me. This matters. Let's start with the numbers, because if you don't feel them in your gut, the lessons won't stick. The NASDAQ Composite peaked on March 10, 2000, at 5,048.62. It bottomed on October 9, 2002, at 1,114.11. That is a 78% drawdown. 2.5 years of sustained selling. Not a flash crash. Not a one-day panic. 2.5 years of waking up, checking your portfolio, and watching your money evaporate, day after day after day. But here's the number that really gets me. Ready? To recover from a 78% loss, you don't need a 78% gain. You need a 355% gain. Think about that. Your investment gets cut by more than 3/4, and then it needs to more than quadruple just to get back even. That's not just math. That's a psychological challenge most people are not wired to handle. And it took nearly 15 years to get back to even. The NASDAQ didn't close above 5,048 again until April 2015. Why did it take so long? 3 reasons, and the third one is the one nobody considers. Reason 1. Earnings had to catch up to prices. In 2000, a lot of these companies had no earnings. At all. You can't build a stock market on vibes forever. At some point, actual profits have to show up. And for many companies, they never did. Pets.com raised $82 million in its IPO. Shut down 268 days later. The stock went from $14 to 22 cents. At one point, Amazon owned 30% of the company, and publicly stated its stake was worth 0. Webvan burned through over $1 billion trying to deliver groceries before anyone was ready to order groceries online. The idea was right. The timing and the price were catastrophic. Reason 2. A second major crash hit before the first one healed. In 2008, the financial crisis hammered the NASDAQ again, down about 55% from its 2007 highs. So if you'd been slowly recovering for 5 years and started to think, maybe I'm okay, the market reset the clock on you. But here's reason 3, and this is the one that changes how you think about index investing entirely. The NASDAQ of 2015 was a fundamentally different index than the NASDAQ of 2000. The index recovered, but most of the individual stocks in it, they went to 0. Permanently. The names that drove the recovery, Apple, Google, Amazon, had either barely existed in 2000 or were trading at a fraction of their eventual value. The recovery was powered by entirely different companies. So when people say the market always recovers, what they actually mean is winners eventually replace losers, and if you hold a diversified index, you capture that rotation. If you held individual stocks, different story entirely. So what are the 6 lessons? Let's get into them. Lesson 1. Valuation always reasserts itself. Always. The dot-com era saw PE ratios that were either infinite because there were no earnings or in the hundreds. The internet was real. The revolution was real. And you still got destroyed if you overpaid. Being right about the future doesn't make you money. Being right at the right price makes you money. Those are two completely different skills, and the market punishes anyone who confuses them. Lesson 2. Index recovery is not the same as stock recovery. I just showed you this, but it's worth stating plainly. Diversification across a broad index protects you from permanent capital loss. Concentration in the future can wipe you out even if you're right about the technology. The NASDAQ recovered. Most .com stocks are gone forever. You can be right about the macro trend and still lose everything. Sit with that. Lesson 3. Your time horizon has to be genuinely long. Not, I'll hold for a few years long. Not even, I can wait a decade long. 15 years. That happened within living memory. If you were 55 years old in March 2000 and needed your money for retirement within 10 years, you were structurally exposed regardless of your conviction. The market doesn't care about your timeline. This is the one that keeps financial advisors up at night. Because most people think long-term means 5 to 7 years. The market has a different definition. Lesson 4. Dollar cost averaging through crashes works mathematically, but it's emotionally brutal. An investor who kept buying through 2001, 2002, and 2003 dramatically lowered their average cost and recovered far sooner than the index headline suggests. But most people stop precisely when they should continue. Here's what nobody tells you. Buying when the market is down 50% feels like catching a falling knife. Buying when it's down 70% feels like setting money on fire. Your brain screams at you to stop. Every instinct says, preserve what's left. And the people who override that instinct? They're the ones who end up wealthy. The ones who can't? They're the cautionary tales. That's not a character judgment. It's wiring. And if you don't build systems to override your wiring ahead of time, you will default to the wrong move in the moment. Lesson 5. Narrative is not a moat. The internet changes everything was absolutely correct. It didn't matter. Being right about a macro theme doesn't tell you which companies survive, which ones capture the economics, or what the right price is. The narrative gives you conviction. Conviction without valuation discipline is just a fancy way to lose money. I want to say that again. Conviction without valuation discipline is not an investment strategy. It's a story you tell yourself while your portfolio burns. Lesson 6. Beware of crashes inside crashes. This is the one that actually breaks people. The real danger wasn't the initial fall. The initial fall was brutal, but a lot of people held on through it. The real danger was what happened 18 months in when you'd been watching your money shrink for a year and a half. The market kept going down, the news kept getting worse, and you finally couldn't take it anymore. So you sold. You capitulated near the bottom. And then you missed the recovery entirely. Drawdown duration tests conviction far more than the initial drop. Anyone can be brave for a week. Almost nobody stays brave for 2 years. The people who lost everything in the .com crash weren't the ones who held through the whole thing. They were the ones who held through most of it, and then broke right before it turned. Now, let's talk about why this matters right now. Because the .com crash isn't just a history lesson. It's a mental model. We are currently in an era where a transformative technology, artificial intelligence, is driving euphoric valuations ahead of confirmed earnings. Sound familiar? Now, to be fair, today is not a perfect parallel. NVIDIA trades at around 25 times forward earnings. Cisco traded at 472 times earnings in March 2000. The numbers are genuinely different. Most AI leaders today have real profits, real revenue, real business models. That's not nothing. But here's what keeps me up. The technology may be real. The prices may still be wrong. Those two things can both be true. And the lesson from history is that when they are both true, it's the people who confuse this technology is world-changing with this stock is a buy at any price who pay the heaviest price. I'm not telling you to sell everything. I'm not telling you a crash is coming tomorrow. What I'm telling you is this. If you don't understand what happened between March 2000 and April 2015, you are operating without a mental model for one of the most important financial dynamics in history. And that's a dangerous way to invest. So here's what I want you to take from this. 1. The price you pay determines your return, no matter how good the story is. 2. Diversification isn't about maximizing upside. It's about protecting yourself from permanent loss. 3. When everyone agrees that this time is different, read the history. It almost never is. 4. If you're going to be in the market, understand that long-term might actually mean 15 years, not 5. Not until I need the money for a down payment. 15 years. And 5. Build your systems now before the panic hits. Decide in advance what you'll do when your portfolio is down 40%, 50%, 70%. Write it down, because your brain in a crisis will not make the decision your calm brain would want it to make. That's not weakness. That's biology. The dot-com crash is treated like ancient history. It's not. The people who lived through it are still alive. The patterns are still with us. And the lesson that matters most isn't about what to buy or what to sell. It's this. The market will test you not once, but over and over for years. And the people who survive aren't the smartest or the best informed or the ones with the hottest tips. They're the ones who understood before the crash came what they were actually signing up for. Thanks for watching. If this video changed how you think about risk, share it with someone who needs to hear it. And if there's one lesson from this era that stuck with you, or one you wish you'd learned earlier, leave it in the comments. I read them. Seriously. See you in the next one.